Lots of talk this week about the potential of a new 50-year mortgage, but I haven't seen anyone doing the math on it. I've seen people speculating, haven't seen anyone doing the math, and I am very concerned about the math on a 50-year mortgage. We're going to get into that and more coming up. Housing affordability is absolutely stretched. You look at any measure from a historical perspective and it's alarming where we're at right now for housing affordability. I've shared before, I've got 3 kids. I'm concerned about how they're going to be able to afford their first house, what that's going to look like. It's going to be very different than when I bought my first house, 20 years ago now. It's just different. It is stretched and it's going to be harder and harder for people to buy their first house. Well, I don't know if you've heard this. It's certainly made a lot of financial news this week. The idea of a 50-year mortgage. And it just sounds outrageous. It sounds outrageous. And I know the White House was talking about it. Kevin Korhorn first sent me an article a couple of years ago about an idea of a 50-year mortgage. A bank was introducing that or talking about it. And so anyway, it's gotten a lot of attention. And initially, you hear 50-year mortgage and you're going to have an emotional reaction. And you know, on one level, you'll say, that's ridiculous. That's how I feel. On the other, you might say, well, we've got to figure out this affordability. Maybe that will help. I haven't seen anyone do the math. I read one article where the individual, the author said this should save a couple $100s a month or I think a few $100s a month, making the mortgage payment much more affordable. And therefore, this is a good thing. But I didn't see the math. And guys, I am concerned about the math. I actually checked it about a half dozen times, even worked with a couple of our other CFPs to say, guys, this is what I'm seeing. It's not exactly what I expected. Are you getting the same numbers? They are. There might be more to the story, but let's dig into the math of the 50-year mortgage before we would even determine, well, is this a tool that someone would want to use? Let's start with just the inputs, okay? I chose a $360,000 loan, okay? So a $360,000 loan, and I'm not assuming any PMI, private mortgage insurance, and I'm also not including any escrow. I'm not making assumptions about property taxes or homeowners insurance. That would obviously be part of your mortgage payment, but I'm just wanting to isolate the variables here and ignore all of that. $360,000 mortgage, no PMI, and no escrow. Currently, at the time I'm recording this, depending on where you live and how competitive and so on, mortgage rates for a 15-year loan, call it about 5.5%. And for a 30-year loan, call it about 6.25%. This is important, okay? So that's what I used in these calculations. So for the 30-year loan, a $360,000 loan, okay, for 30 years at a 6.25% interest rate. Now, with those details, the monthly payment, again, just principal and interest, would be $2,216 and some change. And so that'd be the monthly payment. If you held this mortgage for the full 30 years, which no one does, I'll get to that, the total amount that you will have paid over 30 years for this $360,000 mortgage would be $797,000, just shy of $798,000. Okay. So, and yeah, that's how the numbers work. It's scary when you sign those mortgage documents. That's what you see. So that's the layout of a normal 30-year conventional loan. And if you just take a look at the amortization schedule of just the first year, you can see about $341 going to principal from your very first payment, and it goes up a little bit. Basically, that mortgage over the first year gets paid down about $4,000. So of all of your payments for the first year, you pay about $4,000 onto principal in total. That's the 30-year. Now, here's where it gets fishy. On the 50-year loan, what I think a lot of people are overlooking is they're just assuming the same interest rate. I don't see how in the world a 50-year mortgage would have the same interest rate as a 30-year mortgage. Just like the interest rate for a 15-year mortgage and a 30-year mortgage are different, you would expect a 50-year mortgage would have a higher interest rate, potentially much higher. Think about the risk. If you're the one doing the lending instead of the borrowing, if someone needs a 50-year mortgage, does that seem like a higher risk than a 30-year mortgage? Yes, seems like a higher risk. Therefore, the interest rate should be higher. I assumed instead of a 6.25% interest rate like I did on the 30-year loan, What if it's just a 7% interest rate? And I actually could envision that a real 50-year mortgage rate would be even higher than that. But at 7%, take a look at these numbers. A 50-year mortgage, the monthly payment would be $2,166. Not much different from the 30-year. Barely any savings at all. And if you're as surprised at that as I am, then you know what's hidden behind door number 2. The total amount of payments, over 600 payments for this $360,000 loan over 50 years, is $1.3 million. You knew that was going to be the case. You knew the total loan, if you held it for 50 years, which no one would, but if you held it for that long, was going to be astronomical. But taking a look at this, that is alarming that there's very, very little in monthly savings. And here's why. Take a look at that amortization schedule. That first month, only $66 goes towards principal. Only there's so much goes to interest that only $66 goes towards principal. And if you look over that first year, you've paid down principal of less than $1,000 in that first year, compared to $4,000 for a 30-year loan. You're only paying down that principal less than $1,000 in the first year. So much is going towards interest, very little goes towards principal, and that's why the monthly payment doesn't go down that much. A $50 a month savings. That is not what I expected. And you then go from being sort of objective and saying, well, a 50-year loan is just a tool, right? It comes with big risks and blah, blah, blah. You look at these numbers and say, I don't see how that math would ever work. I don't see how that math would ever work. Now, if there was some sort of intervention and you said, it was required that a 50-year loan had to have the same interest rate as the 30-year loan. I can't imagine a universe where this would work, but say that was required, it was forced in there. Still, the monthly payment does go down, but it goes down a couple $100, not a lot, a couple $100 a month compared to the 30-year loan. But again, you are paying so much more over the life of that loan. And just to save $200, I think ballpark was the difference. Not worth it for the added risk. We'll see where this goes, this discussion about a 50-year mortgage. I just don't see how it makes housing more affordable. I think it adds financial risk. So just to summarize, what the math is telling me on the 50-year loan objectively is it barely, and what are my concerns? 3 primary concerns. Number 1, it barely saves you anything on a monthly basis. That's 1. Number 2, you're barely paying down the interest. You're barely building equity. In the one article that I saw that was painting this as, oh no, this could be a really good tool, it was just sort of assuming that housing values would continue to rise like they have, and like just painted everything, oh, everything's going to be great. We don't know that. And if you're not building a lot of equity, you don't have a lot of margin if housing values go down, or maybe your neighborhood values go down, or maybe your particular house goes down. You're not building a lot of equity. And the other thing, if you say, well, no one's going to pay this thing over 50 years, you're going to refinance or you're going to move. I know. Well, when you move, do you have any equity to use for your down payment of your next house? With a 50-year loan, you're barely building any equity. And then lastly, third, is if you do say, well, I need that savings. My third concern is there are so many other tag-along expenses or surprise expenses that come with home ownership. And I'm a fan of home ownership. Have talked a lot about that. But if this small margin of savings is what tips you from, okay, I can afford the house or I can't, you're overlooking all of the other potential expenses that could come along with home ownership. And it just makes me concerned that you're taking on too much risk if you need a 50-year mortgage. So I don't know, maybe we'll find out something different about the math. I'm just using a generic, as you can see, a generic online mortgage calculator to do this math, repeated it several times. I don't think the math makes sense for a 50-year mortgage. We'll see if there's more to this story for you or even for your kids. The house that you purchase, your housing choices are one of the biggest financial choices that you make in your life. It's typically your biggest expense. And so you want to make sure that it fits within the rest of your financial life, your financial goals, and that you still have flexibility and you're nimble and so on. Work with your certified financial planner. Make sure that you've got the right level of house for your financial situation, the right structure of mortgage. And then if your goal is to either get into a bigger house or get into a more expensive house, or maybe to downsize at retirement, maybe to pay your mortgage off, all of that analysis and calculations, work with your certified financial planner on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well. Or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise steps in your financial life.